Hello, everyone. Very happy to have you here. dLocal and I, CFO of dLocal. You have heard today from us how we created what is one dLocal model. You heard it from Seba, you heard it from Fede, and how that allows us to solve payments, complex payments in emerging markets for our merchants. You heard from John and Maria how that generates a lot of stickiness and engagement, and it allows us to grow with our merchants. Now we're going to see how that, together with our DNA and culture, generates a very powerful financial model. Our financial model has three pillars: growth, profitability, and cash flow generation. When we talk about growth, we focus on all the numbers, starting with TPV, but we particularly focus on gross profit dollars. We have all our internal incentives aligned to maximize gross profit dollar growth. And when we talk about growing gross profit, we talk about bringing new merchants on board, but particularly, as we saw today, growing with our merchants. That implies having basically zero churn, growing organically with them, and bring them to new countries, payment methods, and products. That resulted in the last 2 years to have an 83% CAGR on our gross profit growth. The second pillar is profitability. We have bootstrapped this company from the beginning with a very lean culture. We are 700 people managing more than $10 billion in TPV. And we have a very cost-disciplined approach. We fly coach, we don't have fancy dinners, but particularly we are negotiating every expense that we make as if it was our own. And we hire people and spend resources in emerging markets, finding the best talent, but at more convenient cost. And that results in a totally best-in-class profitability that we measure as adjusted EBITDA over gross profit of 76% in the last 2 years. The last pillar is a strong cash flow generation. We measure the cash flow generation by the conversion from net income to free cash flow, and that has been above 100% or on above 100% in the last 2 years. How do we achieve that? Well, first, with having, as many other payment companies, negative working capital. That implies that the more we grow, the more cash we generate, but particularly we don't have to spend our own money in growing. Second pillar to that is being laser focused with capital expenditure. Our capital expenditures are fully focused on software development, technology, and automation. And that basically represents 5% of our gross profit. And finally, we have a very tax efficient structure, which also allows us to have a strong cash flow generation. When you combine these metrics, particularly growth and profitability, you get to a rule of 40 in our case. You know that rule of 40 of 40 is very good, 80 is great. In our case, has been 159% in the last 2 years. So now let's dive a little bit more in each of these pillars. So growth. I think the slides speak for itself. TPV and revenue have basically doubled in the last 2 years, and gross profit has grew 83%. This is not by chance. You heard from us today. We have grown our countries from 19 to 40. We have grown our payment methods from 300 to more than 900. And we have grown our merchant base from 190 to 650 in the last 2 years. And the result of these are clearly here. When we talk about profitability, we look at adjusted EBITDA growth, which, very in line with what we just saw, has grew 91% in the last 2 years, and particularly adjusted EBITDA over gross profit. If you look at all the periods, you see that it has been on or above 70%, particularly the last 2 years, reaching 76%. But it's not because we haven't invested. We invest a lot. You see both in OPEX and in headcount that we have significantly invested over the last 2 years, particularly focused in technology and sales and marketing, but also in G&A as we became a public company and reinforced our processes and controls. But we have a lot of operational leverage. What does that mean? Even though we invested a lot, gross profit grew even more. And you can see that by the metrics on the top. When you do OPEX over gross profit, it was 44% 2 years ago. Now it's 33% of the gross profit. And the same applies to headcount. If we do the gross profit over headcount, we were generating 184K 2 years ago, and now we're generating 278K in 2022. So the last pillar is cash flow generation. We measure this, as we mentioned, as free cash flow in absolute basis and also over net income. For this particular graph, we are considering the cash in escrow that you are aware that we put in 2022 as part of our free cash flow because we consider that to be temporary. Actually, in Q1, you see that we already collected $14 million, and the rest is expected to be collected throughout this year. So when you look at the CAGR of our free cash flow has been 76% in the last 2 years, and particularly we were close or on 100% of cash conversion. So with all these metrics that you just saw, it's not a surprise that we compare very well against our peers. Companies in general that we admire and great companies. We look at the last 2 years of gross profit, the last 2 years of margins. As 2 years ago, we did the IPO, so it's a good track from there to now. If you take net revenues or what we call gross profit, we are clearly first and way above the average. If you consider EBITDA growth, we come in second after a peer that comes from a much lower EBITDA margin base. And when you consider profitability measured by EBITDA over net revenues or gross profit, we also come in first. Another way to see this is with the rule of 40, again, that combines profitability and growth. And you see it here. I mean, these are all great companies. We stand out clearly first in a 159 ratio for the last 2 years. With this, and considering the audience we have today, I would like to touch base on a couple of topics that come up very frequently in Q&As and in meetings with you guys. One is net take rates, and the other is capital allocation. When we talk about take rates, the first thing to understand is that there are factors that we control, more or less, like pricing or to some extent cost efficiencies, and some factors that we don't control and we don't solve for, which is basically mixes. Mixes of product, mixes of services, mixes of countries, and mixes of merchants. When we talk about product mix, we talk about pay-ins and payouts. All things equals, payouts have a lower take rate. And why is that? They have a very short settlement period, and they are settled through bank transfers, which is a very efficient payment method. So, as you see, in the last year or so, the share of payout has increased, and that affected the take rate, net take rate down. The second mix is what we call service, local to local or cross-border. And again, all things the same, local to local have lower take rate than cross-border because it doesn't have the FX service implied in it. So, and as you see there, sequentially in the past year or so, we have increased our local to local share to almost 50%, and that had an impact on take rate. And the last was in country mix. We operate in 40 countries. All those countries are different. When the country is more complex and we have a more mature solution, we typically have higher take rates than in a country that is less complex and we are just starting. So and then you have countries like Brazil or Chile, which are quite on average of our net take rate. You may have countries like Mexico, which are lower in take rate, which is a very efficient market. And you have countries like Argentina and Nigeria, which are above the average of take rate. If you look at last year, you see that we sequentially increased our share, particularly in Mexico, which is a country with lower take rate. We decreased our share in Argentina, and that basically resulted in a decrease in the net take rates. Another way to see this is with a bridge. So if we do a bridge from 2021 to 2022 and then to Q1 2023, we basically see the impact of each of these effects. In last year, we have a higher share of payouts of 5 percentage points, a higher share of local to local of 10 percentage points, and an increase of share in Mexico and a decrease in share in Argentina. Those three combined resulted in that decrease in net take rate. And on the other hand, we have efficiencies in different markets that offset that by 0.1%. In the last quarter, we didn't have a change in net take rate, but when you look at each of the specific drivers, it was quite the opposite. We have more share of cross-border, we had a partial recovery of Argentina and growth in Nigeria, and that contributed to the higher take rate, and we had some temporary inefficiencies that we expect to revert going forward. So if there are two takes away to this, is first, the main driver of take rate increase or decrease is the mix of products, the mix of services, and the mix of countries. And the other one is, for us, take rate is an output. And it's not pricing pressure, it's mixes. And the second and most important is, this for us is an output. We will always try to maximize our gross profit dollars. If a merchant chooses to work with us with payouts, with lower take rate and pay-ins, that is great. And if they want to launch a country that has lower take rate than the average, it's great, as long as we will always try to maximize the gross profit dollars. With this, let's move to capital allocation, which is a topic that has recent more interest from you guys. So when we talk about capital allocation, we have basically 3 strategies. The first one and most important is organic growth. That was been the bread and butter for us since we started. As you know, we will start the company from the beginning. And we invest in technology, we invest in sales and marketing, we invest in expansion and customer acquisition. But even after we invest significantly on that, as you saw, we generate a lot of cash. So that's why the other 2 strategies become more relevant. And we see them as complementary, and actually they actually compete with each other. In terms of strategic decisions, we have 2 factors there. They need to be strategic, they need to bring commercial distribution or allow us to expand faster to Asia and Africa, and they have to be consistent with our culture, and they have to be opportunistic. What do I mean by that? Obviously, in times where our share price is higher and multiples are higher, we have a better trading currency than when our share price is lower. And the opposite appears for buybacks. When we believe that a price is low, dLocal is the company we know the most. So it competes against any other potential acquisition, and that's the time when it makes sense for us to buy our own shares, to bring the most long-term value to our shareholders. And that's what we did. So we launched our first buyback program back late in December. It was a $100 million program. It's expected to finish in July. We will probably achieve the 100 million or very close to that. And If we show the public information, which is what we show in the last issued financial statements, at that point in time, in mid-May, we had already bought $4.4 million in shares for $67 million at an average price of $5. That represents already 3.4% of our float. And we did that while continuing to increase our cash flow. So even after buying that represented only 87% of our free cash flow of Q1. Again, we will continue to analyze these alternatives. We have a strong cash generation, and we will evaluate whether to use our cash, particularly for M&As or for share buybacks, as the context tell us that will be the best value for our shareholders. And this slide just shows, part of that analysis. It's just a comparison of price to earnings and net income growth, and you see how or why we believe it's a good moment for us to buy our own shares. So the last topic is something that you guys have been asked for, and is showing you for the first time our medium-term objectives. Also an update on the guidance. The guidance we gave for the annual still remains the same. We have more thorough reviews every quarter, so once we publish our next quarterly financial statement, we have a more thorough review. But the guidance we gave, was 620 to 640 gross revenue dollars and 200 to 220 adjusted EBITDA dollars is consistent with the current forecast. Medium term. When we talk about medium term, we think of 3 to 5 years, and we have objectives that we're sharing for you for each of the pillars of our business model. For growth, we expect to continue having basically zero churn. Whenever we measure churn every quarter, every year, it's always below 1%. Growing at this pace implies not losing a single merchant. We will continue to benefit from the organic growth from them, 15 to 20% we saw before with Maria in emerging markets. And on top of that, we will continue to add countries, payment methods, and products. We expect that to result in a gross profit CAGR for the medium term from 25 to 35%. Profitability. The ratio we use is adjusted EBITDA over gross profit. And the same that we have done. We will continue to have a very disciplined cost culture, a very lean organization, and we continue to hire mainly and spend in emerging markets where costs are more convenient and there's a lot of talent. With that, we expect to have a gross profit, an EBITDA over gross profit ratio of 75% or more in the medium term. And finally, cash flow generation. For cash flow generation, the metric we use is basically CapEx, which is one of the main drivers from EBITDA to cash flow. And we continue to be laser focused. Our CapEx will be software development, technology, automation. It has been consistently close to 5% of our gross profit, and we expect that metric to continue that way. We don't expect to spend more than 5% of our gross profit in CapEx. What is more interesting when you combine the metrics, if you combine growth and profitability, that will bring us a rule of 40 as a target for us of 100% or more. And we like a lot that metric because it gives us the flexibility to focus more on profitability or on growth, but at the end of the day, we will have to maximize the combination of both. So with that, I will pass the floor back to Seba and Sergio for the closing remarks. Thank you very much.
Okay.
Mic up again? Yes. No, I was checking if we were live again.
Can you hear me? Yes. Okay, thank you very much for bearing with us for this last few hours. As we said before, we were here in NASDAQ 2 years ago. Tomorrow we'll be ringing the bell once again. We are extremely proud of what we have achieved over the last 2 years, and we are amazingly optimistic about the future that's coming up. And as I like to say, we like to put our money where our mouth is. We announced yesterday that the shareholders bought $160 million worth of shares over the last few months. That was $100 million that General Atlantic bought, and an additional almost $60 million that the shareholders, Andres, I don't know where he is, Eduardo and myself, bought out of our own pocket. So I think that shows the commitment that we have to the business. Again, we are very proud. There's a lot of work to be done. We are only scratching the surface. As I mentioned before, 40 million people paid through us during the last month. Just 3.5 million people were paid through us for the services that they provided. We expect both numbers to grow very significantly ahead. And we are super proud of what we've done. We are super proud of the team that we have. It's a diverse team. Initially, it was mostly Uruguay and then Latin America. More and more, we are hiring people in Africa, in Asia. And we are very proud of our Uruguayan origins. We are very proud of being Latin American. And most of all, we are very proud of bringing and showing the vibrancy and the potential of the emerging markets that are still underserved and that represent a major source of growth going ahead.
Thank you, Sergio. And just to complement on that, I hope you felt the passion that we have for this business. I feel it when I hear our team. This is the work of our lifetime. And I want to insist on this point. If you believe in emerging markets and if you believe in global companies, there's no better way to index yourself to that growth. We could not be more bullish about our opportunities. I want to thank you for the support. I want to thank the team, obviously, for putting this together. It was a lot of work. Thanks for the support. Thanks for the questions. You make us better. This is an iterative process, and we're very open about the fact that we are learning. That's the thing I like the most about my job. We need to keep learning. So keep challenging us. Merchants will keep challenging us, and we'll hope to continue to be able to deliver. We have a break now. 10 minutes break, and we'll go to Q&A. Thank you, everyone.